Trade the situation, not the stock. That's the topic of this week's Stockscores Market Minutes for October 9th, 2012. You can subscribe to my free weekly newsletter at stockscores.com/newsletters.asp, and I also encourage you to subscribe to this YouTube channel so that you can get instant updates when a new video is uploaded. All right, what do I mean when I say trade the situation, not the stock? Well, good traders take their focus off of the stock and put it on the reward and risk of the trade. Good trades are those where the reward potential more than justifies the risk you have to take. A stock may be great to trade at one price, but not at another. Oftentimes, it can be a better trade at a higher price because risk can be managed better. We want to use charts to determine where risk can be controlled and where reward is best. Now let me explain this with an example. This is a stock that I traded today, ANR, on the New York Stock Exchange. Or maybe it's on the Amex. I don't even know what exchange it's on. But the point is, the stock was breaking higher from the get-go this morning. And if you bought it right after the open within the first 10 minutes, you ended up getting in at around $7.10. But we would have to have our stop loss point put much farther lower because that's where the floor price was for the stock. Now, a couple of hours later at the orange lines, we could have bought the stock at $7.15, but at that point, we could have had a lower stop because the floor price for the stock on the chart was a little bit higher. What ends up happening is that if you buy at $7.15 and your stop loss is at $7.05, you've got 10 cents a share in risk. If you buy at $7.10 and your stop loss is at $6.85, well then you've got 25 cents a share in risk. If you only wanted to risk $1,000, you would buy 4,000 shares on the first entry at the blue line, but you could actually buy 10,000 shares on the second entry at the orange line. The price is actually higher, and yet because you are managing risk better, you can have a larger position and ultimately make more money on the exact same stock and the exact same move. All right, let's get into the analysis of the overall market because it's real important today. We have a breakdown from a falling top, a break through the upward sloping trend line that has been underway since June. And therefore, I think that this market is likely to head lower as we move through October. We'll get into the reasons why in a little bit. Let's go look at the TSX, and there again we see a break of that upward trend line. In this case, the upward trend line hasn't been in effect for as long because the Canadian market lagged the US market through the summer, but we did form a falling top. That's what I've drawn with the red line, and the upward trend line drawn in green was broken today. The small caps fared even worse. This is the chart of the Russell 2000 ETF, symbol IWM, and there I have highlighted in red the falling top that formed last week, and we now have a breakdown through the trend line that points to lower prices in the near term. This market looks like it will pull back as well. What's a little bit confusing is that the Treasuries aren't really rallying. If money is coming out of stocks, if money is looking to move away from risk, we would expect a little bit stronger rally in the Treasuries, and that didn't happen. You'll see why in just a moment. Here's the reason. The US dollar was really the source of strength today, and that is largely because of political tension increasing in the Middle East, particularly between Syria and Turkey, and of course Iran and Israel are all part of this boiling point in the Middle East, and that caused people to look for safety in the US dollar. US dollar goes up. Well, what do you think happens to things denominated in US dollars? Things like gold, of course, fall lower. We saw that in gold, and we saw the stock market move down because, again, they are denominated in US dollars, and that hurts US priced assets. The Canadian market went down because commodity prices were going down. Why? Because the value of the US dollar went up. That makes commodities more expensive. The one exception among the commodities was oil. Of course, if there's political tension in the Middle East, that's going to potentially constrain the supply of oil, and oil rallied as a result. And it was perhaps the only sector in the market today where I found good strength. The One of the stocks that I traded today, ANR, which I talked about at the top of this video, is of course a resource energy stock, and it had a pretty good run today, as did many of the energy stocks. So I am pessimistic on US and Canadian stocks in the short term. I think that we have seen a little bit of a breakdown. Wouldn't surprise me if the market bounces back tomorrow, but we are seeing some money start to come out of these out of the stock market right now. I'm only lowering my rating on gold to neutral because it still remains in an upward trend. Yes, it is pulling back, but it is not pulling back in a way that breaks that optimistic trend. Oil, I'm neutral on. Yeah, it broke higher today, but I have found that these Middle East related tensions usually dissipate after a while, and the rallies in things like oil are usually short-lived. So I think you trade it and you be bullish in the very short term, but don't be thinking that it's time to build long-term positions in oil stocks just yet. Tension in the Middle East has brought money into oil and caused the US dollar to rise. The rising US dollar accentuates concerns about corporate earnings and is likely to motivate a pullback in stocks in the near term. Caution is warranted. Have a great week in the market and trade well.